Hello and welcome to Accounting 2208, Chapter 13 tutorial on accounting for warranties. We'll be going through the Galaxy Company example. It is recommended that you download the accompanying file for this particular problem. So Galaxy sells laptops at a price of $3,500 each, and they come with a 3-year warranty that requires the corporation to replace parts and labor. And so what we're going to do is assume that the warranty is honored equally over 3 years. We'll see how that plays out. Now, during 2013, the company sold 300 laptops, and based on prior experience, it estimates that the cost for repairs under warranty is going to be $150 for parts and $200 for labor for each laptop. And during 2014, repair costs were $12,000 for parts and $24,000 for labor. The first requirement for this problem is to record all the necessary 2013 journal entries, and so we'll begin with the recording of the sale. At December 31st, 2013, we don't know when during the year this happened, so we just, for convenience sake, enter it at the end of the year. We're going to debit cash or accounts receivable for $1,050, which is 300 laptops at a price of $3,500, and of course recredit sales revenue. Our next journal entry is going to be to accrue the associated warranty expense, and we do this because of the matching principle. We want to be able to match an estimated value of warranties against the particular sale that we incur, matched against the sale. So we're going to debit warranty expense and credit warranty payable for the amount of $105,000. That's calculated as 300 laptops times 150 in parts and 250 of labor. This is parts plus labor. And at this point, there are no warranty costs incurred in 2013. Just to make it simple, we'll just presume that any warranty claims don't start until 2014. So now that we've recorded the revenues and associated expenses for these particular laptops sold during the year, we can start to see what's happening with our warranty payable account, which is our liability associated with having to pay out some claims on the laptop or on the sale of the laptops. So our warranty payable credit in our December 31st entry was $105,000, and that's what the balance is at the end of the year, since there were no warranty costs incurred during the year. For simplicity's sake, we'll start dealing with the costs in the next year. And the important thing to note that this $105,000 is for 3 years of warranty remaining, because they are 3-year warranties. Requirement 2 is to show the December 31st balance sheet and income statement presentation. So we'll just show a partial balance sheet and income statement for these. What we have here is a current liability of a warranty payable of $35,000. Now note that this is not the full $105,000. This is $105,000 times 1/3, which is 1 year. So what we're saying is, of this $105,000, $35,000 is current, and the other remaining amount of $70,000 is long-term. That's current. And so you see here, as we build out the balance sheet, here is the other long-term portion. Then we're going to see what our partial income statement looks like for the year ended December 31st, 2013. And what we have there, of course, is our sales revenue and our warranty expense. And both of these are straight from the journal entries that recorded the revenue and the associated matched accrued warranty expense. Requirement 3 is where we start to account for warranty costs that we incur to service the warranties. And from the data in 2014, the company incurred $36,000 in total costs of parts and labor to service the warranties. And so what we're going to do here is we're going to debit the warranty payable that we had already set up for this. We do not want to expense, right, these items anymore. No more expense, because these have already been expensed in the accruals. Our credits are going to be to parts inventory, and again, no more expense. And because what typically happens is the company will pull parts out of inventory to service the warranties. And if they have to buy the parts, then it'll be accounts payable or something like that. And then they may have to pay some labor, so that's where the cash or the wages payable comes in. And then what we can do is see the impact on our wages payable T account here, where if you recall, we had a balance at the end of 2013 of 105,000, and here now is where we draw our warranty costs, or our cost to service the warranties, from the payables. So because we are presuming that no other sales associated with warranties happened during the year, that's why this T account doesn't change. Or to make it easy, you can track each year's warranty separate and then add the balances in the T accounts. So this doesn't mean that the company no longer sells or includes warranties with their product. It simply means that we're just being careful to account only for the warranties associated with the 2013 sales. And what we're left with then is a balance at the end of 2014 of 69,000 going forward to cover the remaining 2 years. The fourth requirement is to show what the December 31st, 2014 balance sheet looks like. We're not going to worry about the sales. We haven't gone further with this problem to generate more sales and additional warranty costs, so we don't have enough information to actually do the income statement. So all we have here on the balance sheet is a current liability of $34,500 and a long term of $34,500, and that is $69,000 spread over the remaining 2 years. Requirement 5 carries on this example. It starts out or includes the same initial details, but in this case, customers have the option to purchase an extended warranty for an additional 2 years. Now, this is something akin to if you go to Best Buy or you purchase a laptop from Apple, the standard warranty is 1 year. You can purchase an additional 2 years on top of that. And so in this case, the 3-year initial warranty is still in place, plus 2 years beyond that. So really, we're looking over a 5-year period on this particular problem. And so what we're saying here is for the 2-year extended warranty, that comes at an additional $250 cost. And so what we're going to do is discuss how this warranty should be accounted for in years 2017 and 18. So don't forget that the initial 3-year warranty covers 2013, 14, and 15, and now the extended warranty goes into 2017 and 2018. So our first journal entry, and this is back in 2013, so this would be in addition to the normal sales entry, so the sales and the matching warranty expense. But in this case, we're saying that half, or 50% of the 300 laptops purchased, half of those customers will pay $250 for the extended warranty, and so that's how we arrive at $37.50. So this, we receive that money either in cash or accounts receivable. But what's interesting here is that this is unearned revenue. We cannot record the revenue on extended warranties until the period comes where we might actually have to service those. So this becomes a deferred item, and we're going to credit our unearned warranty revenue, and we'll leave that there until 2017 and 2018. And so now we jump ahead to 2017, which is the first year of the extended warranty. It's at this point that we can actually earn a portion of the extended warranty. So the $35,500 times 1/2 is $18,750. So we're actually going to record this. There should be a credit here. We're going to debit the unearned revenue, which we originally credited, and now we're going to credit the warranty revenue. And so if we had a T account for the unearned warranty revenue at 2013, we would have $37,500. This is in 2013. So now we can earn half of it, 118 or 18,750, leaving a balance of 18,750 to carry forward, and we recognize that in 2018. This is 2017. Now the next entry that would normally happen as part of this, also in December 31st, 2017, would be any warranty expenses that we incur. Now with this problem, we never told you, there's no information as to how much the company had to pay to service it, and it really doesn't matter. But what happens here is, notice that this is a debit to warranty expense. And then we have a credit to either cash if we have to pay, accounts payable if we're purchasing something, if we have to pay labor, if we have any parts in inventory, we pull those out. But the key thing here is that with sales warranties, and that's what this is a sales warranty. When we get into the extended warranty period, all of the or whatever portion of the sales warranty that can be recognized in that year will be recorded, and so we'll have, let's say, a revenue of 18,750, and let's say for example that we incurred $5,000 to service the extended warranty. So we would have extended warranty expense of $5,000, and that means that we would have made $13,750 off the extended warranties. This is an important thing to note. There is a reason why companies sell extended warranties, is because they make a ton of money off them. They take a risk management approach and sell warranties at $250 or whatever it is. Salespeople tend to put the fear of God into customers so that they buy the warranties. And make no mistake, if the companies thought that they would have to pay a lot of money to service the warranties, they wouldn't sell the extended warranty. So they are selling you peace of mind, and in doing so generate a fair bit of profit for themselves. And again, the same thing happens in December 31st, 2018, the second year of our 2-year extended warranty, which is when we can then record the remaining 18,750 of our revenue. So if we go back to the unearned warranty revenue, you recall that our balance at the end of the year was 18,750, and this is at the end of 2017, and now we have 18,750 that's recorded as revenue, and that's what's happening over here. And at the same time, if there was any warranty expense incurred in that year to service the warranties, then the journal entry would be exactly the same. Again, a debit to warranty expense. The wonderful thing is, if there's no cost to service the warranty, all of this revenue becomes pure profit to the company. And again, that's why they sell them. They are quite profitable. And this slide just takes away all the green and shows what all of the associated journal entries for this requirement is. So 2013, 2017, and 2018. The last requirement, 6, has us redo parts 1 to 4 again, but this time only assuming that the company is paying for the parts and that the customer is going to pay for the labor. Okay, it won't take us long to proceed through this. We start again with the original sales entry. We have $1,050,000 on our 300 laptops sold at a price of $3,500. We, in this case, continue to accrue the warranty expense, but this time the warranty expense is a little smaller, only because we are including the parts, not the labor, okay? And again, no warranty costs incurred in 2013. So we have a credit to warranty payable, a debit to warranty expense. And we can go back and look what that T account would look like in this case. You recall in the first example it was originally $105,000, but now because we're looking only at parts, we have a $45,000 accrual, and that is the ending balance for 2013. If we were for the second part, or the second requirement related to the previous data, we're attaching it to part 6 to see what the balance sheet would look like. What we have here is $15,000 current and $30,000 long-term, and again, this is the $45,000 parts, right? This is a 3-year warranty. This is 1/3 and this is 2/3. It's very important that you make sure that you capture this because if the warranty is only 1 year, then we're okay in recording the entire amount as a current liability. But when we have warranties that extend beyond 1 year, we have to make sure that we're constantly updating the balance for the appropriate amount. And so this makes sure that our ratios and everything, continue to be correct. And then our income statement. In this case, we have our $1,050,000 in sales revenue and a smaller warranty expense only related to, again, the parts. The third requirement was to deal with any of the costs associated with serving the warranties. So if we go back and recall that from the data, originally the company had to service a total cost of $36,000, but remember that that was for parts plus labor. So now we're only looking at the parts portion, which is $12,000. So we're going to pull some parts inventory, so that's why we're we're crediting parts inventory because we're going to draw some parts out of inventory, and we're going to reduce the warranty liability, the warranty payable, for the amount of the parts only. And then in this particular case, remember that the customer is paying for the repairs. So customer pays labor. So in this case, we'll presume that the customers had to pay a total of $24,000 in labor. And because they're paying for it, for us, this is a debit to cash for the company. And in terms of the credit, it could be one of two things. If the company pays wages expense and the customer is paying for it at cost, well, then all we're doing here is we're just offsetting the wage expense. But really, this becomes an opportunity for companies to earn additional revenue through servicing the products that they sell. And so that's what happens here. So in this case, we could say that we're going to have additional revenue of $24,000, and somewhere in the background they would be tracking what the associated expense. So if we wanted to know what the profit on servicing that warranty is, we would have to know that the wage cost maybe were $20,000, and so on servicing defective products, we make $4,000 profit or something like that, right? So, but suffice it to say, it's either a direct reimbursement of the costs incurred by the company by having people do the work, or it can be considered service revenue. And then we can go back and look what our T account would look like. Recall that our initial accrual of in 2013 of $45,000 and a $12,000 debit for the parts. This leaves us with $33,000 remaining, and that's going to be split to 2 years. And 33,000 divided by 2 is 16,500 each year, which takes us to. Now for the last slide, we are just going to review what the balance sheet would look like under this revised scenario where we're accounting only for the parts. Recall that from the previous slide, we had a total warranty payable remaining of $33,000, and that's basically split 50-50. All right. So that concludes this tutorial. We hope you found it useful.